Hi everyone, welcome to this session of the Tiger Academy, US Stock Financial Statements for Beginners. In the previous lesson, we covered the 3 key elements of a cash flow statement as well as 2 important accounts that will help us judge the sustainable competitiveness of a company. In this lesson, I'll be showing you a fun way and helping you to quickly assess the cash flow of a company and its viability as an investment. A cash flow statement is simply a record of a company's inflow and outflow of cash. To give you a deeper understanding of this idea, I've put together some cash flow scenarios for us to look at together. I've arranged 8 different combinations of cash coming in, positive, and cash going out, negative, to illustrate the value of the data in the cash flow statement. The 8 combinations fall broadly into 2 categories. Using these profiles, you'll be able to determine which characteristics are positive and which are negative and need to be improved. Let's now look at the first category: companies with positive cash flow from operation. Profiles 1 to 4 above are for a company with positive cash flow from operation. Profile 1, Treble positive, the Mermaid. Treble positive indicates net cash inflows from operation as well as from investment and financing. Companies of this type have a seamlessly endless supply of cash, and I suppose you may find them attractive. But beware of any company with profitable operations and positive cash flow from investment that is not engaged in any investing activity. Why does it continue to raise money through financing activities just to fill its pockets with more cash? Deception is a mermaid's trademark. A mermaid is a beautiful creature with a sexy song that attracts sailors to the rocks on which their boats crash and sink. So when everything looks great, but you sense there is something wrong, they say the company matches the mermaid profile. There are 2 possible explanations for this scenario. One is that the company is raising a large amount of money for a planned investment project, possibly a good thing. The other scenario is that the enterprise is using its status as a listed company to raise money that will eventually be siphoned off through shell companies, not a good thing. So, when you encountered one of these triple plus mermaid companies, you should take care to do more research and find out if the company has any sizable investment projects in the works. If not, proceed with caution. Profile 2, double positive, 1 negative, the cash cow. Double positive, 1 negative companies have profitable operations, but it should be noted that there are 2 scenarios for positive cash inflow from their investment. Either the company is receiving interest and dividends from its investments, or it is selling off its assets. A company with profitable operations generally does not willingly sell its assets. In the case of a cash cow, we can usually attribute the positive cash flow from investment to investment income. Negative cash flow from financing indicates that a company is either paying dividends, purchasing shares, or repaying debt. If your analysis shows that the cash inflow from investment doesn't come from the sales of assets, and the cash flow from operation and investing activities covers the cash outflow from financing activities, we can draw the basic conclusion that a company is in good shape. However, looking at it another way, positive cash flow from investment can mean that the company has slowed or stopped expansion, and so the prospects for its continued growth may be less than ideal. Companies of this type are like good cow that regularly produce milk. As long as the price of the cow is reasonable and its milk production is good, we can consider investing in them. Profile 3, positive, negative, positive, the entrepreneur. This type of company has positive cash flow from operation and financing, but negative cash flow from its investment. It's obvious that this type of company invests all of its cash, whether from operations or from the insurance of debt and equities into new projects. They act like ambitious young startups. We can call this type of company an entrepreneur. Startup companies develop rapidly and grow quickly if their investment projects do well. But if those projects fail, this type of companies can face huge losses. When evaluating an entrepreneur as a potential investment target, you should think of yourself as an angel investor. Angel investors are not just fools with a lot of money. Instead, they focus on the fundamentals of a company. This can include things like the maturity of the business model, the size and growth of the company's market, and the quality of its management. If, for the moment, you don't feel like you have strong fundamental analytical skills, I suggest that you take a step back and just put these types of companies on your stock watch list. As your skills improve, continue to monitor their development, And, in most cases, time would tell. Profile 4. One positive, double negative. The star. One positive, double negative type companies are characterized by operating cash inflows and investment and financing cash outflows. Cash inflow from operation indicates that a company is operating. Normally, cash outflow from investment indicates that a company is expanding extremely, and cash outflow from financing indicates that a company is paying dividends or repurchasing its shares to increase value for shareholders. You might say that these are dream companies, working diligently on their exciting businesses, actively expanding, and rewarding their shareholders to boot. The star not only helps shareholders make money, but also continue to grow fatter. You should definitely consider this type of companies as good investment targets. Of course, we should always keep a cool head and look at the ongoing performance of a company. Without consistent performance, a one positive, double negative star may turn into a one positive, one minus, one positive entrepreneur. How can we tell whether this sort of change will happen? The answer is simple. Subtract net cash flow from investment from net cash flow from operation, and then subtract net cash flow from financing, including dividend payments. If the differences is positive, then it's a good bet that the company is a star. If negative, there is a possibility that it could turn into an entrepreneur at any time. Okay, so companies with positive cash flow from operating activities can be considered relatively good investment targets. Now, let's take a look at companies with negative cash flow from operating activities. What will the four profiles look like? Negative cash flow from operation means that a company is not generating cash inflows. These companies are generally going downhill, and it's not a great profile for an investable company. Negative operating cash flow means that a company does not generate cash inflows, and such companies are generally in a period of decline. This profile is generally not a good candidate for investment. As I mentioned in the previous class, a company can operate for a while without making a profit, but it won't last long without cash flow. A company with no positive cash flow is probably not far from being delisted. Now, let's take a look at some companies that fall into this category. Profile 5. One minus, double positive. The Fugitive. Companies of this type have a combination of negative cash flow from operations, positive cash flow from investment, and positive cash flow from financing. This means that a company has no cash inflow from operating activities and has stopped expansion but continues to raise funds. A company that is neither making money nor expanding but continues to raise funds is very likely to be on the run soon, so we call such a company a fugitive. This verdict is not final. Of course, if this kind of a company can improve its operations, it could become a triple positive mermaid. In that case, you can continue tracking such a company. With decent management that has no intention of turning the company into a fugitive, it's not completely hopeless. Profile 6. One negative, one positive, one negative. The question mark. We call a company the question mark when it has negative cash flow from operation and negative cash flow from financing, which means that it is hemorrhaging cash and that creditors are pressing for repayment. In this circumstance, even if cash flow from investment is positive, we need to explore the following two scenarios. In the first situation, if cash flow from investment comes from successful investment activities, the company may yet be turned around and become a double positive, one negative cash cow if operations continue to improve. In the second situation, if cash flow from its investment activities is derived from the sales of assets, then the question mark is already rotten to its bones and completely hopeless as an investment. Profile 7. Double negative, one positive. The Gambler. These companies have negative cash flow from operation, negative cash flow from investment, and positive cash flow from financing. They're like a gambler who is losing money in a casino but keeps borrowing money from people to continue gambling. Even if a gambler gets lucky for a day and generates positive cash flow from investment, this type of company would generally continue to lose. It can depend on luck to last, and it's certainly not the basis for an investment strategy. I suggest you avoid these companies like plague, as you'll never make a silk purse out of a pig's ear. Profile 8. Treble negative. The black hole. Very few companies have negative cash flow from operation, investment, and financing all at the same time. This type of company can be likened to a black hole. No matter how much investment you pour into it, the money will be lost due to mismanagement. Don't even think about making an investment in one of these companies. just take a pass on them. So, you can see that by creating a cash flow profile for a company, you can now access its value as an investment target. You cannot act on love at first sight when investing. Don't jump to conclusions when the basis of a single research report that shows you a pretty face. Keep in mind that you'll actually have to reveal at least 5 years of financial reports to determine which type of cash flow profile fits a company. I've summarized the 8 profiles with respective investment advice in the table below to help you remember. Okay guys, that's all for today. Keep these 8 profiles in mind when making your investment decisions. See you next time!